guaranteed income after you graduate. Learn more about degree insurance now.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Hello, and welcome to Taming the High Cost of College. I'm your host, Brad Baldridge. Today's interview with Wade Eyerly, we talk about insurance. This is a new type of insurance that's out there that helps colleges guarantee that you will have a decent income once you graduate from college. Now, not everybody who graduates from college will have a decent income, and that's where the insurance comes into play. And they will actually provide that income that person missed because of their inability to find the appropriate work. Later in the interview, we talk about different earning potentials when we talk about STEM and liberal arts and how that works out. All right, let's go ahead and jump into the interview. Today, I'm talking to Wade Eyerly. He is the CEO and founder of Degree Insurance. Welcome, Wade.
Thanks for having me. I appreciate it.
All right, so can you tell us a little bit more about Degree Insurance? It's relatively innovative. I've not seen this type of stuff before, and I've been looking for it, obviously, because of the podcast, et cetera. So what is Degree Insurance, and why did you feel it needed to be started?
Yeah, well, I appreciate it. A few years ago, I was running an airline, and I sat on the board of a school board of a high school in Bridgeport, Connecticut. And we took kids that are a couple years behind in the sixth grade or so and got them caught up and into college. And that was kind of the mission. We used a lot of Teach for America teachers. We were really proud of what we were doing. And the entrepreneur in me wanted to tell the story of how we're altering life's trajectory with education, right? What happens to these kids from, impoverished backgrounds, household incomes under $35,000 a year? Like, what's happening to these kids after they get them into college? And the startling answer was 80 to 90% of those kids were expected to drop out in the first 2 years. That's the part I didn't know. And it shifted me from proud of the work that we were doing to, I don't know how to describe it, immediately embarrassed or ashamed. We weren't helping as many kids as we were materially harming, right? Going to college, getting into college is not the path to the American dream, right? Graduating is. And it's a subtle but pretty important distinction. And so if we just got kids into college, we enabled them to take out debt, we actively made them poorer. That we were doing harm where we thought we were doing good. So, and if 80% of your kids are going to drop out, you're doing more harm than good. So I set out to change that, and I had to figure out why kids are dropping out. And 8 out of the 10 top reasons students and their families will give you for why they drop out are variations on the phrase, "we couldn't afford it." And that's true for so many kids, but it's also the mask we wear, right? It's the safe answer for why you drop out of college. It's what you tell when you don't want to tell what else is there. The reality is, maybe not all, but the vast majority of those kids who dropped out could have borrowed more money to go to school. Right? The federal government would have extended them more credit. We know this drives the 1.7 trillion in student loans that we like to talk about, right?
Right.
So we know they could borrow more money. What it really means is what they're saying is they don't think it's worth borrowing money anymore. And that was the interesting piece. It's a crisis of confidence. It's a place where the risk they take, the cost that is up front and front loaded, doesn't seem to match with the benefit on the back end. And yet we know empirically, the data is very clear that college works. If a college degree were a stock in the stock market, right? Buying that degree would outperform the S&P 500 by 2.4 times and simultaneously be the most consistent performer in history. It is quite literally the best thing you can do with money.
Right.
So it works very, very well. The average student in America is going to borrow $7,000 a year. Going to take 5 years to graduate now. We all think of college as a 4-year experience. It takes 5 on average to graduate. They're going to finish then $35,000 in debt. And the terrifying piece, they're going to take 21 years to pay back those loans, right? it takes them a generation to pay back those loans. And that sounds horrible, and college costs too much, and all of those things are true. But the reality is that student is going to earn, because they got a degree, $2.4 million over the term on average. Again, these are all averages.
Right.
And the payment's $181 a month on average. So would you pay $181 to earn $2.4 million? The answer is yes. And you do it every time and twice on Sunday, right? Like there's no scenario where that doesn't make sense to do.
Right.
The problem is, and what really comes up is that no individual is an average. Your student's not an average. You're not an average. So the question is, how do we take the risk away? The risk of of the college degree somehow not performing for you in particular, right? Where it doesn't perform to that same level. Right. And the reality is, the thing that determines whether or not your college degree pays off is none of the things you think. It's not where you go to school. It's not your GPA. It's not where you get published and who you studied under and all of those things that we like to think. Those things matter, but they're marginally important. The thing that is really determinant on the performance, on the ROI of your college degree, like did you earn more than you would have as a high school graduate, is very simply the state of the macro economy in the year you graduate, right? If you start college in 2005, your junior year, Apple unveils the iPhone and unlocks a tremendous amount of economic potential. Smartphones, apps, all of it. Your senior year, Lehman Brothers is bust and there's no jobs, right? We enter the Great Recession. Either one of those two things is more predictive of your lifetime earnings than anything you did in college. So what we learn is that higher ed in a crass way almost is like a roulette wheel where 9 out of 10 spaces pay off, because 9 years out of 10 in the United States are good years economically. 1 in 10 is a housing crisis or a pandemic or 9/11 or 1 out of 10 is a down year. Right. Graduating in that down year is disastrous. You anchor your market rate at a low point, and while the economy rebounds, you get a 3% annual wage increase or whatever it is. And you'll set a family back for a generation by graduating in the wrong year. The wealthy effectively already know this, so they self-insure. In a down economy, graduate enrollments spike. Because if a college degree is a roulette wheel where the odds are 9 out of 10 spaces are going to pay off, then good advice would be borrow as much as you can, by which we mean go to the best school you can, put it on red and spin, right? And 5 years from now when you graduate, it's likely to pay off. In the event that it doesn't, what's the right response? Well, the odds are still the same. So borrow more money and spin the wheel again is the right play. The problem is first-generation students, first-generation Americans, underrepresented minorities, the Pell-eligible poor like I was, often don't have that chance. They can't. They got to go to work now, right? They did it right. They put their time in. They got their degree. They can't double down. For those people, graduating in the wrong year really does set a family back for a generation. Their kids will be saying, hey, mom, hey, dad, I just got into state. Can you co-sign my loans? And they're going to be saying, I'm still paying on mine and it didn't work for me, right? And you start to see the narrative emerge that we hear very commonly now is, is college worth it? College isn't worth it. Bill Gates didn't need a degree and all that kind of stuff. And the reality is you can point to outliers. A college degree is unlikely to change your upside, right? The maximum that you could earn. But it most definitely changes the downside, right? It's a safety net. It's the floor of what you could earn. Right. When you look at economic downturns, look at the Great Recession, right? Same story we were talking about before. Unemployment nationally goes to 10%. Black unemployment hits 17%. The unemployment rate for someone with a college graduate peaks at 5%. The single best thing you can do in an economic downturn is actually have a degree to prevent yourself and your family from feeling the pain of that downturn. You look at the pandemic, and Rod Chetty at Opportunity Insights out of Harvard talks about the K-shaped recovery. So basically, in the pandemic, if you had a college degree, you worked from home, and if you didn't, you experienced layoffs worse than the Great Depression. But the break point was, again, the college degree. Having that degree, like I said, might not materially alter your upside, but it definitely changes your downside. Right. And so you're protecting yourself from experiencing that pain. The degree is then, in some form, its own insurance, right? It's macroeconomic risk insurance. Well, what we do is we look at that and we say, okay, for these students who are dropping out, what is it they're missing? What they're missing is that confidence that it's going to pay off. Well, you or I wouldn't be able to buy a home if it wouldn't make sense as an investment, as something you did with cash. If it could, that home could just burn tomorrow and it'd be gone and wipe out, 3 times your net worth or whatever it is. You wouldn't do it. Couldn't buy a home. So homeowners insurance creates the opportunity for us to buy homes. The same thing really holds true here. Where else in your life would you counsel someone you love to borrow 10 or 20 times their net worth, make a single investment with it, and then just hope that it works, right? You wouldn't do it if it was Amazon stock. You wouldn't do it if it was Bitcoin. I don't care what you believe in. It's not a good investment strategy.
Right.
And so along the way, but we get away with it because it works so well. Well, right now, those students somewhere along the way are losing confidence that it's going to work. They're afraid the home is going to burn down. What if I graduate in the wrong year? What if they don't like my degree? What if? And so they drop out and they say, hey, I'm 10 grand in debt and I'm going to end up a bartender anyway. Being a bartender with 20 grand in debt isn't better off, right? So I'm just going to drop out. What they don't know, and no one will tell, is that a bartender with a college degree is employed more often and at a higher rate and more consistently than one without. It just still works. Right? A degree is a signal that the market uses, and the signal is still very strong. Right. So we know it works. We know empirically it works. So what we have done is built an insurance to protect against the largest uninsured investment you or your family will likely ever make, and that is your college degree. There's a long answer to a short question, but
right, absolutely. So I guess tell us more about this then. So the degree insurance is essentially an insurance. Now, again, it's provided through a college, so you're not going to be able to go buy it directly. But so what is degree insurance? How does it work?
Yeah, so we guarantee how much money you're going to make in the 5 years after you graduate. That's the period where the college ROI really shows up. And what we're guaranteeing is, there's something you would have earned as a high school graduate without a degree. And I don't know what that number is, but let's call it 11 or 12 bucks an hour in Amazon warehouse, right? With inflation, those numbers are changing, but let's call it that. That's roughly 23, 24 grand a year. And it's not unreasonable to think that a high school graduate could go earn 23, 24 grand a year. So when we go to college, what we're trying to buy is a greater earnings level. Now, there are some students out there that are going to be, the modern equivalent of Victorian era gentleman farmers that are going because it's a luxury and they can better themselves than the rest. For most of us, we're going to make more money. We want to earn more. And so that's what we're trying to get. That's the ROI. That's the return on investment we're looking for. So if you're going to make 24 grand a year without a degree, what are you trying to make with a degree? Well, I'm studying, insert your major here. I'm studying business and I'm hoping to make 40. What we're going to guarantee is the difference, really the distance between that 24 and that 40. So we sell it to a college buys it. They use it to recruit and retain students. They use it to tell your student, hey, if you go here, we'll guarantee your salary for 5 years after you graduate. So yeah, you might end up $35,000 in debt, right? That's the average we talked about earlier. But we're going to guarantee your salary. We're going to guarantee you make $35,000 a year, let's say. So what happens is the student can change their major as often as they want, just like home. That's part of the expected college experience. You're going to take the gen eds. You're going to figure out who you are, be exposed to new things. Right? We don't expect you to know what you want to be at 17 or 18. And so, but now they know what it means as they change majors, right? Well, I was an econ major and I had 4. I want to be a philosophy major, but I only have 36. You can still make that choice. You don't have to do salary seeking. But now you know what the impact of that decision is, right? So students make their decisions. They figure out what they're going to study. They study it. They graduate. And then for 5 years, they're going to send us their tax returns. It's objective. It's verifiable. It's third party. You know what it says when you send it to us. And we said you were going to make 36. You only made 32. We're going to end up cutting you a check for the difference. So we cover you across that whole 5 year period. It's cumulative coverage. So you're going to get a single check at the end of that period. And if college didn't work for you, you're going to get a chance to reset. Whether that reset means pay down your loans, whether it means you're going to go to graduate school, whether it means you're going to pay off that high interest car loan you had to get because college didn't work the way you thought it would, right? We give you that chance to reset. So what it does is it makes sure that the investment you're making can't fail you, right? It's a hedge. That's where you get the term hedge in hedge funds, because they make investments with a protected downside.
Right.
And your degree is just the largest uninsured investment you'll ever make. So we've built a hedge for that.
Right, exactly. And of course, like all insurance, there's terms and conditions and, again, so that it's quote unquote fair to both parties, where people aren't intentionally skipping work because they feel they can get a payout some other way. So can you talk a little bit about the typical rules? Like, again, well, I went on to grad school, so my income is zero. So now I'm going to just collect on this insurance. Obviously, that's probably not going to work. So tell us how that works.
Yeah, so you have to take a job inside the United States. And the real reason there is we just don't have data on what a good job is in Nairobi or Tokyo or wherever else. So you can still go take a job overseas. You just take your risk back on yourself, right? But the income guarantee is here for you. You got to take a job in the United States. You can't commit a felony, right? Changes your employability, right? Changes who's willing to hire you. And in the event that you do Teach for America or Peace Corps or graduate school, like you said, we actually just pause your coverage in those years. We don't want you to lose anything. We don't want you to have, I would hate for someone to say, I would have gone to grad school, but I had this insurance and I didn't want to lose it. I didn't want to lose my ability. So what we do is you got 5 consecutive years of coverage. But if you're going to go do Teach for America for a year or graduate school or whatever else, we just pause that year and we pick you up on the other side, right? And so you've still got 5 years of coverage. But when you're doing that non-salary seeking thing, when you're on it, doing church missionary service or, Job Corps, AmeriCorps, whatever it is, we just pause your coverage and pick you up on the other side. It's pretty easy.
Right. So then I guess the other important thing to realize is this is provided by the colleges. So they kind of negotiate as far as what the guaranteed level is going to be. As you mentioned, it's by major. So an engineering major who tends to have a higher salary might be guaranteed at $45,000, whereas a teaching major might be guaranteed at $35,000, let's say.
That's right.
So it's whatever those numbers are, the colleges make those decisions. And
no, we make that decision.
Well, you make that decision, but the colleges decide, and pay the premium typically.
That's right. The college pays the premium and extends then that offer to all the students, right? So there's nothing for the students to buy. The university is the one standing behind essentially their product. Right. The reason we all shop at Costco or Nordstrom's is because, you can take back anything, right? College is the one place where you can't return the product if it didn't perform as intended. So we give you that same kind of financial security.
Right, exactly. So in the end, this is kind of a new idea. And if people are interested in it and you want it, that means you need to ask for it at the colleges and or find colleges that are offering it. Unfortunately, at this point, it's not something that you can do independent of the college.
That's right. You've got to go through the college has to be the buyer. And there's a good reason for that. If an Hispanic woman is going to make 88 cents on the dollar to a white male with the same degree from the same institution, I don't want to sell her a product that costs her more and gives her less coverage. Right?
Right.
That seems terrible. So instead, what we do is we do a group policy. We cover everybody. And then it doesn't matter who gets caught in the safety net. So a safety net is supposed to catch the people that are wobbliest on the tightrope, right? That's what it's there for. And we all believe we're going to cross the tightrope and we're going to do just fine. But in the event you don't, you want a safety net there. Well, there are people who are going to carry disproportionate risk going to college. First generation students is an example, right? It doesn't cost more, but it costs maybe a higher percentage of discretionary income. It's a greater risk. Sometimes they don't see the same level of rewards. Well, what we do is we give everyone the same safety net. So those people are disproportionately likely to fall into the safety net. But that's okay. That's as it should be. Everybody's better off for having had the safety net there.
Right.
So that's why we sell it to colleges.
Right, exactly. So because this is insurance, you touched on homeowners insurance a while ago, but just to kind of clarify that, this is a form of insurance, which means a good chunk of the people out there are going to say, well, I had this insurance and I never claimed. I never got any benefit from it. Just like your homeowner's insurance, right? Nobody says, oh, I hope my house burns down so I can make a claim on my homeowners. Most families will pay, $600, $800, $1,000 a year for their homeowner's insurance and not make a claim ever or go 20 or 30 years between claims.
Yeah, the best case scenario with all insurance is that you never have to use, right? You don't want to end up in the safety net. You want to end up across the tightrope, right? You want to have made it. So like all insurance, you hope you never use it. Nobody gets up on the 31st of the month and says, gosh, I got to get in a car wreck today, or I'm never going to see my money on that car insurance. You know?
Right. Exactly.
You hope you never get in a wreck. Same thing here. The hope is getting a college degree is going to work really well. It's going to pay off just like you hoped the day you signed up, right? And it's going to work, and your career is going to go great, and you're never going to need it. That's the best outcome for you and for me, right? But in the event that it happens to fail, we're going to pick you back up, give you a chance to reset, start over. That's really what the safety net does. The same way as your example with the homeowner's insurance, you hope your home never burns down. Nobody's ever disappointed that they didn't make a claim against their fire insurance, you know?
Right.
But the one guy in 30 years whose home did actually burn down, you're really glad they got to rebuild. You feel for them. And we're going to do the same thing here. We're just extending it to college students all across the country. Right? And when somebody makes a claim, you'll be glad for them that they got a chance to reset.
Right. Exactly. And I think that flipping back around to that, just like your home is not likely to burn down, and that's why you can pay relatively small amounts of money, even though your claim could be hundreds of thousands of dollars. But in essence, a lot of people pay small amounts. Only a few people collect the big check. It's and that works the same way here, which kind of leads us to, going back to the statistics where there's a good chance a typical average college graduate is going to beat the benchmarks that you're putting out there. So I think, that the data we've talked about, you're willing to consider it reliable and, base your career and your company on it. Can you speak to that a little bit about what kind of success rates or odds and, versus also the kind of the dispersion, right? The average musician makes X, but a rock star makes, hundreds of millions. So, kind of that same dispersion idea.
Yeah. So we actually produced some of our own rankings that are kind of interesting because we use this. If you have an average or a median, exit salary of X, but the variance is really wide, it doesn't tell you very much, right? So we tell you you're going to earn 45 and you might make 12, but you might make 90. That actually isn't useful information very much. But if we tell you you're going to make 45 and you might make 42 and you might make 48, so you can rely on that 45, right? Like, you're going to get there. So we, in our own sort of internal rankings, we use that variance to, punish those schools with wide variance and benefit those with shallow variance. So, because you need that information to make sense, right? It helps make the decision all the way along. So ask me the question again. I'm sorry.
Right. Well, so just that concept of variance, right? Can you give us some ideas of where we see variance and where we don't?
Well, every college, every major is going to have different sets of variance based on the majors, right? Very good programs will have high exit salaries, but it's not just that exit and that median exit, it's how likely you are to hit that matters. So I told an example, I've repeated this anecdote a couple times, but my dad's best friend when I was a kid, I asked him what he studied and he told me sociology. And I was 10 or 11, but I asked him why. And he said, it had the highest exit salary of any major at the college. And even at 10 or 11, I thought, really? Because, you hear you be a doctor or a lawyer and they're all rich or whatever. It's not true in either case, but you would hear that growing up. And I'd never heard you got to be a sociologist and you just really mint coin. People just really pay a lot for sociology.
Right.
And so we got back in the car and my dad said, there was an NFL quarterback, famous one, who was a sociology major out of that school. And it made sense, right? The variance was really huge. Most people were making 25, but one guy made $50 million, right? And so then the average is real high.
Right.
And it was a lesson to me as a kid. You got to be careful about statistics that you're using. Well, we spent 4 years here collecting data using publicly available data sets, everyone you can imagine, Title IV data, the first destination reports that schools develop, all the data they send back to the Department of Education on how their students fare when they graduate, how long it takes them to get a job, what kind of jobs they get by major, et cetera. We looked at a bunch of state data sets that were like your state unemployment insurance is a percentage of your salary, right? So the state knows what your salary is. For everybody who works and we looked at data sets of where those people then had gone to school and what they'd studied and when they graduated. And that we were able to piece together then, right? What's the growth rate of salaries? What happens not just, when you graduate, but who gets promoted faster, right? And what happens in years 2 and 3 and 4 and 5? And that allowed us to give it a period of coverage. Instead of saying your first job out will be X, we're able to say, we're going to cover you for 5 years. We're really going to give you a chance to reset, a meaningful chance to reset. And we have some proprietary data sets we pulled in, and we pull all that together and we build our actuarial tables. And that's really kind of how we do it. So every school gets a single premium. So it's the same cost per student because you don't know at 17 or 18 what you're actually going to graduate. And then we give them the different coverage levels based on major.
Right.
Very, very simple.
Right. But I think along those same variance lines, from a parent perspective, I think there's this, and maybe they're not really thinking a lot as, the hard science and the idea of variable incomes and all that kind of stuff, where but they have this gut reaction around majors that lead to obvious careers as compared to majors that lead to, potential, but not necessarily, a great job. Like a nursing degree or an education degree heads you straight to nurse or teacher. And they're relatively reliable. There's lots of data on what those types of careers pay, et cetera, et cetera. And then, as you mentioned, a sociology degree or a psychology degree or liberal arts of various types often pay well in the long run, but in the short run, it's not a clear path to X career with Y salary.
Yeah, I mean, we graduate 27,000 philosophy majors a year in the United States, and there aren't 27,000 working philosophers in the United States total. But every year we get 27,000 new philosophy. And that's true of a lot of majors. We have 35,000 French majors a year. There aren't 35,000 jobs in the country that require French. In fact, the most common job that requires French speaking in America is teaching French to more students who will then sit in that same cycle, right? But it doesn't mean these things aren't worth studying. Right. And you're absolutely right. A lot of parents will think, oh, my kid needs to study STEM, and STEM remunerates higher on the way out of college. And they're not wrong, but they missed something in that sort of story. So if I run an insurance company, I run a startup. And if I needed to hire a new coder, right, a new computer science graduate, I could hire a kid just graduated, and I know exactly what they could do because their degree says computer science. Right, they went into college and they couldn't code. They came out, now they can. I know what they can do, and I can pay them a market rate because I know exactly what they're going to do. If I hire an English major, right, I don't know exactly what he or she is good at. I know they're smart. I know they're creative. I know they can write. I know they can problem solve. I know they're critical thinkers. But none of those are the task-oriented skill set that I'm going to need to hire them for. So I'm going to hire them at a lower rate, and then but they get promoted much faster, and they get promoted faster because I'm now training them on the task I need done, right? And so they're getting better at the thing that they can do. So 10 years into your career, a STEM major and a liberal arts major are going to earn the same amount, right?
Right.
But if you look at a lifetime earnings curve, the liberal arts major never catches up because there's this lag in the first few years where they're earning less. So if you think, hey, I need to make, $75,000 a year to support my family, both of those degree choices, liberal arts or engineering or STEM or whatever, are fine paths to get there. And it's likely that you don't need to earn that in your first years after you graduate, right? They call it a starter home for a reason, right? And if you find you're going to be much happier as an English major, right, then that might be a much better path for you. Money doesn't equal happiness. In fact, there's a lot of data that says after $60,000 a year, under $60,000 a year, increased sort of remuneration, increased salary does actually increase happiness. But after that, it has no effect. Once your needs are met, right, you got ability to save a little bit. You can buy a new car when you need, whatever it is. A speeding ticket doesn't throw off your family, balance sheet for 4 months,
right?
Which is the case of a lot of people in America, including me growing up. Then money no longer sort of has any influence on your happiness quotient. And so, you can pick that path that's going to let you be happy, and it'll still get you to that same stable spot. It takes a couple years, right? It's just a different path. So that actually unlocks more students to maybe leave STEM and say, okay, I'm going to study this other thing that I love. On the flip side, they might go, yeah, true, but I'd rather take the early money, right? And so I'm going to study STEM. So students still get to be students, they still get to figure out who they are. But it's important to know that, all those dynamics show up in the data.
Absolutely. Well, and I think another important thing to realize is I'm not pro, any one thing, but I think there is a lot to be said for studying and getting involved in a career path that you enjoy. And I don't know how, and I don't know if there is any, if you've ever seen any data around that, but I'd love to see, if you're doing what you love, do you get paid more? Because you tend to work harder at it. You tend to be good at it. If you're in a job you don't enjoy, I mean, I remember those days, right, where you showed up, but your heart wasn't in it and your productivity wasn't very good and your et cetera, et cetera. Whereas if you're doing what you love, now it's not work so much. You work more, you think about it in the off hours because you're excited about it, so
Yeah.
are you aware
Amy
of anything like that by chance?
Yeah, Amy Wisniewski at Yale School of Management has a lot of writing on the impact of what she calls being like mission-oriented work that you sort of believe in, and its impact on happiness and earnings and the rest. There is a body of research around exactly this, around happy workers are better workers, more productive. So when you're running a company, you want to hire people who genuinely want to be there, right? And so if you don't love numbers, then being an accountant is a tough 40-year slog, right?
Right.
But
absolutely.
if you look at that and it's like a detective solving a mystery and you're like, I can't get these two columns to reconcile. What am I missing? And you can get lost in that for hours on end. Man, oh man, I hope you become an accountant. We need those people.
Right.
And so,
exactly.
there is definitely a lot to being happy in what you choose. That said, follow your passion or follow your bliss can be truly detrimental advice to people.
Right.
Because you need a safety net. You need a floor still. The college degree actually enables it, right? Lets you do those things. Because you have a degree, you can take risks, right? You go over and start a business or, flip homes or do these other things. And if it doesn't work out, whatever thing it was you wanted to do, your fallback position is not, I'm a high school graduate. It's, I'm a college graduate. Your fallback position isn't 23 grand a year in an Amazon warehouse, but instead, 35 grand a year as a mortgage lender or whatever. It changes the level of stability you can be certain about. And part of that is because you never lose the degree. It's not like, if I take a risk now, what job will I have when I'm done? Well, you're still going to be a graduate of Morehouse or a graduate of, Lincoln or a graduate of Tennessee, right? And so that doesn't go away. The signal that degree sends to the market is still just as valid. So it actually unlocks creativity, any degree. It doesn't matter, in fact, that signal is strong. Like I said, being a bartender with a degree makes more money, is employed more consistently than one without.
Right.
Nothing about your college experience, at least formally, was probably about slinging drinks, right? And yet, it works there.
Yeah,
so
I see a strange reference there as far as college and bartending. So,
yeah, like I said, formally, you're not going to learn that, right?
Exactly.
So why does it work there? And the answer is the market just respects the signal, which means there is an element of studying those things that you enjoy and you can still get to where you want to go, right? I met a woman the other day, had dinner at like a conference thing, and she's one of the foremost experts in national security policy in the United States, and she's an English major, right? And she said, I needed it to build who I am and this base of knowledge, and you can learn from history and writing those lessons that we don't want to repeat. And it influences how she helps shape our national security policy. It's a fascinating take, right? Steve Jobs, the Apple founder, talked about how the most important class he took in college was calligraphy because he learned to make things beautiful and the value of taking the time to be a craftsman and to make even your words beautiful. And so when IBM had DOS, he had a graphic interface that let things be beautiful because people want to interact with that. Like, so there's a lot that you get to develop and study, but and we can unlock innovation and invention and creativity because you have a safety net, because the floor is there. You can take new risks that you couldn't or wouldn't, or it would be irresponsible to take without that safety net.
Right. Absolutely. All right. So it was a great discussion around some of these things. If people are wanting to learn more about, this newer idea of insurance, and again, so this podcast could be listened to, in the next 6 weeks. It also could be 3 or 4 years into the future.
Sure.
So this is kind of a newer idea. So can you tell us a little bit more about, how we'd find it or what we'd ask for. Or if we're a parent of a sophomore or junior and we're saying, hey, I like that idea. I hope there's lots of that stuff around when we're picking a school.
Degreeinsurance.co is the website, and is always going to be a repository and a place that you can go to learn more. I think when you visit a college campus or you talk to a school, you should be asking, are we going to get a guarantee? If not, why not? Do you guarantee that this is going to work? Because you could. Because while it is new, those schools could offer this now. So if they don't, you should ask why they don't want to stand behind what they deliver, right? Why won't you guarantee it? And the reality is that not only could they should. And so I would be asking at every school visit, every time you interact with a college, but are we going to get an income guarantee? Is there a guarantee that this works? And, those folks in the next 6 weeks who listen to this and then do it, they're probably going to get, what? I've never heard of that, right? Because we're not in a lot of schools yet. But, as time goes on, you'll get more and more of that. And I do believe this will become the default setting, right? The same way that you and I expect to be able to return something to Amazon or, when you order shoes online or when you walk into a Walmart, you can take it back. Brakes didn't work, et cetera. I believe this will be the new default setting for education, but it's going to take us a couple years to get there.
Right, for sure. Well, I really do appreciate it. And we'll put links into, the things we've just mentioned. And it was great talking to you. Let's stay in touch.
Thank you so much for having me on. It's been a real pleasure.
All right. This ends our podcast today. As always, please leave us a review in iTunes or wherever you're getting your podcast. We'll see you again next week.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Brad Baldridge is a registered representative of Cambridge Investment Research and an investment advisor representative of Cambridge Investment Research Advisors, a registered investment advisor. Securities are offered through Cambridge Investment Research Incorporated, a broker-dealer and member of FINRA and SIPC. Brad owns two companies, Baldridge Wealth Management and Baldridge College Solutions. The Baldridge companies are not affiliated with Cambridge Investment Research.